Hi, and welcome to the Commonwealth December Market Update. My name is Brad McMillan. I'm Commonwealth's Chief Investment Officer. We've got a couple of things to talk about this month. First of all, the financial markets. The U.S. equity markets actually had a great month, one more in a string of them, after a pretty difficult October, if you remember. Second of all, the economy. The U.S. economy continues to do quite well, even though the rest of the world is having trouble. And third of all, moving into the holiday season, what does all of this mean going forward? So let's start off with the financial markets. All of the U.S. markets were up significantly in November. We had a tough October, as you remember, even though we ended up okay, but November continued a strong move upward, and this is good for a couple of reasons. First of all, it shows that the very strong positive seasonal factors are continuing to operate, which is probably good towards year end. Second of all, it repaired some technical damage that was done in October, and right now all of the technical factors, again, look pretty good. No guarantees, of course, but right now the trends appear favorable for the rest of the year in the equity markets. In the debt markets, what's interesting is we actually saw interest rates decline. We would normally see them increase as U.S. growth increases, but what's holding it down is weak growth in the rest of the world. This is actually a good thing for the U.S. as this stimulates the U.S. economy and helps us grow even faster, but it is unusual and it does depend on the weakness in the rest of the world, which is going to create some headwinds. What we saw in the past month, we saw Japan formally enter a recession. That was a bit of a shock, and it led Japan to actually implement massive quantitative easing, which surprised the world and knocked their currency down. That was what you could argue a measure that is almost desperate. The Japanese economy is in trouble. If we look at Europe, we don't see that kind of weakness, but we do see continued weakness, and that's something that Europe is going to have to deal with. China continues to have questions. Russia and other countries continue to suffer from the low oil prices. All of these factors say that the U.S. right now is the engine for global growth, and that's likely to continue. So what does that mean for us? Well, first of all, it's a bit of a headwind. The U.S. economy is exposed to weakness elsewhere in the world. We live in the neighborhood. We can't not be affected by it. And we've already started to see growth moderate a bit at the end of this month. We've seen some contrary indicators. It's not completely positive. It's still very positive, but not completely. Second of all, it's something that's going to affect us going forward with our trading partners and how we have to interact with them. So that's a longer-term issue. But in the shorter term, we have significant benefits in the form of those low oil prices. That is essentially a tax cut that puts money in the pockets of the American consumer, which is a really, really good thing because we're entering into the holiday season. As we move into the holiday season, you're going to be hearing a lot of commentary about how holiday sales are going to talk about what the economy does. Black Friday didn't come in very well, but ignore it, because there are other better indicators of how holiday spending goes, and they're set to say we're going to have the best year in many years. If you look at Black Friday itself, we see spending brought back by sales before then and translated to the internet. So this statistic is not as meaningful as it once was. Looking forward to the rest of the month, I expect we're going to continue to see fairly good numbers across the board. We, of course, have the risks out there, but right now I think the trends are favorable, and I think I will be looking forward to speaking with you next year. Have a great holiday season, and thanks for joining us.